Hello, ladies and gentlemen. Good morning, good evening, good afternoon, whatever you have at your own country. Now, really quick disclaimer before I get into what I have to say is that this is not financial advice. Do your own research, do your own due diligence. Nobody will give you the right advice to how to spend your hard earned money. So, with that in mind, let's go back to the chart. Now, for those of you who have very short attention spans, I'm gonna be very short and concise and summarize it, but by saying I think we're gonna have a rally. Okay. Now I will say that I have various reasons for determining that. Now, when I say a rally, some people would call it a dead cat bounce. Some people would call it a fake rally, if you will. Again, there will be a lot of people that will call it a lot of names. Um, Now, I think we're gonna have a rally that will be combined with the Santa Claus rally, basically with the end of the year rally, run up at least, appreciation and price action, if you will, whatever, if you want to be very specific. So basically, now, pardon me for the chart becoming cluttered in a couple of seconds. You'll see exactly what I mean. Now, we have reached certain peaks, and those who follow the Tom Nash community, by the way, shout out to all you legends from the Tom Nash community. Those who know exactly what I'm talking about, I basically follow my assets right now through following the major indices. I will probably make a more dedicated video later down the line. Also, I will try to make more of these videos if more of you will actually like and subscribe. In fact, if I will see that the audience really likes this, I will do my best to make those weekly. Now, I cannot promise anything, but I'll do my best. So, as I was saying, in my opinion, I think we're gonna have a rally. I determined that by looking at various technical indicators, which I'm again not gonna break down individually right now. If you follow the community, and by the way, the community, Tom Nash's community, is $5 a month. It's supporting Tom, and as a perk, you get the Discord and you get the community that I'm talking about. So, in my personal opinion, we're actually experiencing an Elliott wave pattern on the major indices, and they all move alike, maybe with a slight difference to relative price to each their own, obviously. And yeah, we do have some individual stories like Tesla. And by the way, do not get it wrong, I'm quite a Tesla bull. I'm absolutely a great believer in the fact that Tesla is the future. And I do know Elon Musk has some controversies, uh, but I do believe that Tesla itself, SpaceX, and the Boring Company as a combination are basically dragging humanity into the future, and humanity is fighting Elon Musk in this process, like we're a baby having a tantrum while having our diaper changed, which we should be grateful for. But I'm not good. This video is not gonna be breaking down Tesla, Elon Musk, none of that stuff. But if I've mentioned that, since in fact, just an example, something that does not follow the major indices right now is actually Tesla, and the reason for the breakdown is the are the earnings, which some people would consider to be not good at all. On top of it, we have the AI day, which I at least personally learned from a lot of people, talking to a lot of people who trade, invest, whatever, part of the industry, part of the financial markets. And turns out most people have not watched the actual AI day, let alone they have watched very bad short summaries that do not really convey what AI Day had to offer. And it is quite amazing, in my opinion, how Tesla caught up with Boston Dynamics and in a lot of variables, in a lot of ways. Again, the robots those two companies are building have very different purposes, very different applications. I'm not gonna break down all that, and I would have been far, far happier if Elon Musk would have bought or at least tried to buy Boston Dynamics out of Hyundai's hands rather than buying Twitter. I do not understand Twitter, the Twitter purchase, but I'm not gonna get into that topic, I think, at all, other than say that I'm not for that purchase. I do not understand it, and I do know that going back on that deal will cause some harm, but I do believe that in the long run it will cause more pros than cons. Now that's regarding Tesla in particular, so that's why Tesla right now deviated from how the major indices are behaving. So basically, stocks that that do have a bad fundamental story do get the reaction. Meaning, if the fundamental story is bad, the stock will react negatively, will depreciate in price. On the contrary, if you do have a mind-bogglingly huge positive story, like with Palantir, for example, with 9 billion contract just now, and pretty much every other day they close another contract, and it seems like the stock is not reacting. So, again, I'm a big proponent for Palantir personally. I believe that if even if Palantir right now would have been at $30 a share, I would have still been screaming my head off that it's criminally undervalued. I think people do not understand yet how grandiose and um, how much applications there are in the world for Palantir, and hopefully soon we will get to see more and more applications and more contracts come to fruition, and less usage in military applications, which I do know and believe and very much respect and believe is the backbone of the business. Pardon me. But I am a big believer again in Palantir, and as I was saying, it's a fine example of a stock that does not get compensated. Basically, a company that whose stock does not get compensated for the company's efforts. I know there are some holes in the story, and this is what I'm all about this story here, after all. But I do believe that Palantir will sooner or later will be understood better, and as such will gain more momentum, and most important, by Wall Street. But setting all that aside, going back to the rally and my expectations, now I'm gonna say that I expect the rally to bring us back to around 4,100, and I'll explain. Um, the Elliott wave itself, if you guys look it up online and try to understand it better, because again, this is not going to be a dedicated video to Elliott wave, is basically constructed out of multiple head and shoulders and inverted head and shoulders patterns. Most likely, again, it's not always a rule of thumb, but in most cases, that's the reality. So again, the chart will become very cluttered. Pardon me for that, but try to focus what I'm talking about. I think it might help. Now, on this particular chart, what you can see are Fibonacci retracement levels, which are quite powerful support and resistance lines for, well, that depends on the time frame you're measuring, really. Some of them help me find intermediary support and resistance lines, things that we basically see on the daily and weekly basis. I do not scalp nor trade the daily trades nowadays. I mostly aim for swing trades, which require me to wait anywhere between at least a couple of weeks up to a couple of months, and sometimes even a little longer, but usually it is within the time frame of 3 months. So even if you don't believe in the Santa Claus rally, and you don't believe that conditions right now are in fact improving, then even with that in mind, you should be able to see the pattern that is being created. Now you can see that basically those who know the MA system, the moving average system, how it works, and how now all these support lines overlap, and they need to go back in order for the market to see a true recovery. Now, in reality, we have reached what I consider a true bottom. In fact, this is what is considered to be, and most analysts would recognize this is a double bottom bear trap, being that the price action hit here a bottom, started rallying, then we saw a secondary bottom, which, by the way, those in the community who know me, I expected this bottom not to reach that low. I expected it to be slightly higher than the actual bottom, and maybe slightly lower than this particular shoulder. Here we get a head and shoulder, an inverted head and shoulders pattern, which I expected to start correcting somewhere along these lines, basically closing some gaps. There is a whole theory of trading gaps, and I might go into that on some later videos. But in this one, I'll just say that we had to close some gaps. That's on the technical side. And as such, I expected the market, the price action at least, to go down to these levels. And I was talking about that up until we actually crossed these levels, opened up new gaps, closed them as well. And it seems like the market is gaining a little bit momentum. Now, the bigger the time frame, the bigger the potential move or swing that you're looking at. So even if you do not believe in the Santa Claus rally, no problem. But even when the market goes down or up, doesn't matter really, it is very similar to a shark. It's moving all the time. If I'm not mistaken, don't remember my details about sharks as accurately as I used to, but I think shark moves about even while it's sleeping a little bit. It has to, if I remember the facts correctly. But bottom line, what I'm trying to say is that even when the market goes down, the price action will still do that by moving up and down, not in a linear fashion. Okay, it's not gonna go flatline like a heart EKG, like a heart monitor, if a person, God forbid, dies, right? So I believe there will be a correction, at least to where you see these higher highs meet on the daily chart. You can see it very clearly. I think we can see it very clearly on the weekly chart as well. Right here, now the chart will become cluttered, as I was saying earlier. Pardon me for that. Try to focus on what I'm talking about. Now, a lot of these are support lines that I have determined through them being already coming in play before, intraday support lines, Fibonacci retracement lines, closed gap lines. So various support and resistance lines that we have determined throughout the last 6 to 10 to 12 months, around this period of time. So now I'm going to try and at least hide the SMMA so it will be less noisy for you to observe what I'm talking about. Now, this is, by the way, the head and shoulders that we ended up getting, which is basically, you see this high, this is the left shoulder, bottom, head, higher high, bottom, right shoulder, and we went completely down to close these gaps that we had from before. Now, my expectation, in reality, I'll move the lines about just for a second so you could see. In fact, I just corrected them the other day. I expected the market to behave more in this fashion, maybe, okay, to try and at least close some of these gaps that we have opened from before and correct downwards and be maybe a little bit less steep. My line appears over here. So basically, I expected this head and shoulders to look something more akin to this. If anything, no, in fact, this is wrong. Pardon me again. I expected the chart to look more like this. Basically, us closing some of these gaps that you see hiding behind. You see even the writing gap. All of these are gaps that we opened up between days on market close, pre-market, post-market, post-market, pre-market rather. Again, pardon me. And on weekends as well, mostly. Those are usually the bigger gaps. Now, the gap strategy basically says that, especially on the major indices, gaps will be closed, and that's due to a lot of bots trading in on the markets. In fact, I would argue that it's around 70% of all trading volume is due to and is in control of the bots. Now that is because the vast majority of the money in the market is in hold of the financial institutions, and the ones who can really use really powerful, really efficient bots are the financial institutions. So as such, you get most of the money being moved by the bots that those institutions use. So if you look now at the lines that have appeared, and you recognize this is our actual highest high that we had right prior to the pandemic effects hitting. This rally is due to the Fed buying up bonds and basically flooding the market, and well, you know what happened then, and now basically we'll have to pay for it, and this is why inflation is so rampant. But there is a whole argument that I'll go back to in a second. Now, I would say that in fact things are not as bad as they seem. Now, going back to the chart that explaining the technical side of things, I do expect the market to correct at least to this diagonal resistance. Okay, basically we are moving into a wedge. We are in fact moving sideways with very high volatility, but we are moving sideways into this wedge for, well, since, I would argue, since around May 22. You could even argue that somewhat prior to, but realistically speaking, my placement of this would be at around May 20, at around May. This is where we started going sideways into this wedge, and now we are wedged between this bottom that we had, and as I was saying, a double bottom bear trap, basically the price action breaking down lower than our previous bottom, and as such falsely making the bears go into the market, thinking the market will tank completely and they will profit from that, and then the market pivots, reverts, and goes higher. As we can see lately, that's exactly what we've been having in the past week, at least, right? Now, this week will be very, very, very important. We'll be able to see whether we were actually starting this rally upwards as I was expecting. You see, I had 3 potential points from which we will start rallying. In fact, we ended up rallying from the point that I expected the least. Actually, this point is corrected. I had it slightly higher, okay? So this is how I expected it to be. I am not ashamed of my own mistakes, and I do have a certain deviation of my margin of error, if you will. Again, I'm just a human. Even bots make mistakes to some extent, if you want to call it that. So the reason I called 4,100 is at this point, even if we move at this very, very slow rate, our highest point on this range would be roughly around 4,100, as you can see on the right side. The black price point is marking where the mouse is, and I'm pointing at this upper resistance, diagonal resistance. So this is how I'm deriving the 4,100 area. And again, remember, the market is like a 6-year-old child. It can deviate slightly, to the left, slightly to the right. It's like trying to expect a semi-truck to stop on a dime when it's going to 100. Not going to happen. There will be a turning curve. Depending on how rapidly and what will be the momentum that we will gain going upwards. Remember, also there are gaps that we haven't closed yet, and when the market gets so close to these areas, it is very much attracted to close these vacuums, if you will. Especially the bots, they see these areas as vacuums that need to have trading going on through, basically closing them by having continuous trading going through. You can even see these gaps, and when I say gaps, I'm referring basically to a hole in the price action. Okay, again, by the wicks it's really hard to see, but there is a slight gap. So slowly but surely, I believe we will close them. At least one of them we will get into this around these areas, and very much very much as I expect is to have um, the Santa Claus rally, and if the Santa Claus rally, basically end of the year rally, will take place, we will we see the price action breaking through this resistance, exceeding it, and again maybe even making some higher highs than what we had around the previous rally that ended up being around 4,336, which, as you can see, again coordinates very well with that diagonal resistance that we derived simply from these 2 points. Okay, so it's there, it's not imaginary. Pardon me again. Now, the argument about the inflation. I'll try to finish the video on this, as I'm probably been dragging this video on far too long. But some people argue that things are not getting better, and some, in fact, would argue that things are getting worse. But I have done my own survey and started looking, and again, I am a consumer just like all of us, and I pay attention to the prices. And I have noticed that prices are not going down. They're at least stopping, meaning again from being at 9 whatever, that on the previous month being 8 whatever, and there is an increase on that, and then suddenly not going to from 9 to 10. That for me is a sign. Again, we're slow. Again, maybe we're not decreasing, but at least we're slowing down. In fact, I would argue that some things are depreciating and actually becoming cheaper, and more so the CPI reports give us an indication. If you look at in the last 4 months, we have continuously been going down. So it seems like inflation has peaked. Again, I'm not arguing that's the case, but at least at the current time, it seems like inflation is slowing down. And if you look at various things, even that, again, a lot of people argue the real estate market, and I would argue that this market is one of the most lagging ones. So, and especially the U.S. being a main indicator, and for the U.S. is very different. Most houses are being built from lumber, and if you look up lumber right now dropped, if I'm not wrong, below its lows before the pandemic. Meaning lumber right now is very, very cheap, and a lot of people who insisted on continuing to build their projects so they will not stay stagnant, ended up overpaying and now trying to get their money back by asking for inflated prices, which most people are not willing to go for because of interest rates. So, and I probably will make a dedicated video to interest rates, but I do think that we have another 0.75 basis point rate hike in the near-term future. We know that the Fed currently have not reached their threshold, so we still have some room to go. And I will probably make a far shorter video talking about the Fed's balance sheet, which has not been addressed by a lot of people, and I think it's a very crucial, pivotal point on how the market is going to react and behave in the near-term future, as well as I do think, and as far as I remember, there's a lot of money sitting and being hidden, so to speak, in the 3-year bonds, which will start expiring soon. Ladies and gentlemen, again, if you remember, most of them have been issued right post-pandemic at around 2020, so probably we will see to see some action regarding that towards the end of the year of 2023. So just to kind of emphasize a couple of other points, we have the VIX slightly decreased. The VIX is at around the 29 area, and those who use it as an indicator know those are, well, not low levels, but especially the way the chart looks, basically seems like we're pivoting back down, and the lower the VIX is, the better the people who go long on stocks are off. That is that, as well as if we're looking at pre-market at this current time, pre-market is mostly green. Again, that's not a certain indication, but still is something to pay attention to. The fear gauge went all the way from extreme fear to neutral, back to 45. So again, that's another indication that the markets are improving. Um, and another thing I wanted to mention is this week's event. So on Monday, we do have PMI, which might give a bit of a reaction to the market, but even if it's going to be horrible, the market will not react for far too long. I think that will be a short term reaction, if at all. More so, we have pardon me for being not so prepared on the details of this week. And we have crude oil inventories on Wednesday, which might affect the prices of oil, prices of energy, and subsequently the stock market will react as well. As we know, the correlation there is negative, usually, because again, higher prices of energy, meaning for the companies to just move product about, or even receiving um, raw materials, or pretty much anything to do with their operation, is very much affected, especially those, again, that their profit margins are made by the fact that energy prices are decreased. Usually those will suffer the worst now, as we already spoke about in the Tom Nash community. And we have also unemployment claims on Thursday, so be ready for a turbulent week. But I think overall we are on a way to a rally. Now, again, as I said, this is not financial advice. Do your own research, do your own due diligence, make your own decisions. But these are my opinions about what is going on. And one last thing, because again, I spent some time in making this video for you guys, and the more people will like, subscribe, press the bell icon, and do the all the stuff that YouTube wants, I will try and make more of these videos. I know this video was somewhat long, but I had a lot to say, and in fact, I assure you guys that there's far more to say about the markets and where we're headed. But again, this was too long, so I'm not gonna include my other opinions in this, and I will keep those for separate videos, like the Fed's balance sheet and so on. For the time being, I wish us all a wonderful trading week, and I wish us all to make a lot of money. Peace out.